$45 billion. That's what one hedge fund managed on the 1st of July this year, after posting a 439% return in 6 months. Not over a decade. 6 months. Its founder was 25 years old, and Wall Street had started calling him a prophet. 30 days later, $45 billion had collapsed to 10. The prophet was margin called out of his own prophecy. His entire public portfolio sold at a discount to the richest market maker on earth. This is the story of the fastest rise and fall in hedge fund history, and why it might be the first crack in the AI bubble. Because to understand how $35 billion evaporates in a month, you need to understand that this isn't a story about a gambler. It's a story about a genius who was right about almost everything, except one number. Leopold Aschenbrenner grew up in Germany and graduated from Columbia University as valedictorian at 19. He landed on OpenAI's superalignment team, the group responsible for keeping future superintelligent AI under control. In 2024, he departed, and then he published a document that changed his life. It was called Situational Awareness. 165 pages arguing that artificial general intelligence was coming faster than anyone was pricing in, and that trillions of dollars would have to pour into chips, data centers, and the power grid to feed it. Silicon Valley passed it around like scripture. People called it the AI Bible, and the money followed the scripture. Stripe founders Patrick and John Collison, former GitHub chief executive Nat Friedman, investor Daniel Gross, the elite trading firm Jane Street. They all backed a hedge fund named after the essay, run by a 20-something with no professional investing track record. It didn't matter. Conviction was the credential, and for 2 years, it was the greatest trade on the planet. Long everything the AI build-out needed: memory chips, data center capacity, power infrastructure. Since inception, the fund returned over 1,000% after fees. By this July, it managed $45 billion. One of the fastest asset ramps ever recorded. The portfolio read like the essay come to life. Korean memory giant SK Hynix, AI cloud builder CoreWeave, Micron, SanDisk, and on the other side, short bets against the old world. Legacy software companies. The thesis said AI would eat, but the returns had a secret ingredient: leverage. Up to 4 times. For every dollar investors put in, the fund controlled roughly $4 of stock. When your positions rise 10%, you make 40. It's the closest thing finance has to a cheat code, as long as nothing ever goes down. Because the math works both ways. A 10% drop erases 40% of your capital. A 25% drop erases all of it. At 4x leverage, you're not betting that AI wins. You're betting the market never seriously dips. Not once. Not even for a week. And the banks were happy to lend the rope. Prime brokerage is one of Wall Street's most profitable businesses, right up until the moment it isn't. In late July, the dip came. The 5 biggest tech companies told investors they would spend at least $600 billion on AI infrastructure this year. And somewhere in that announcement, the number flipped. It stopped sounding like growth and started sounding like desperation. Because if you have to spend $600 billion building capacity, one question gets very loud. When exactly do the profits arrive? Then SK Hynix, the Korean chip maker at the heart of the AI memory boom, and one of the fund's largest positions, reported earnings. Profits were up sixfold. Sixfold. And it still wasn't enough. Expectations had run so far ahead of reality that a 6 times profit surge read as a miss. The stock fell 19% in a single session in Seoul. Within days, more than $1 trillion was erased from chip stocks worldwide. Micron down 30%. SanDisk down 30%. Samsung, SK Hynix and Micron alone shed over $460 billion in market value. And the most leveraged names fell hardest. CoreWeave dropped 20% after a failed merger and a short seller attack. For a normal fund, a week like this is painful. For a fund running 4x leverage, it's fatal. Every 1% the portfolio fell, the fund's real capital fell 4. And somewhere in a risk office at a very large bank, a threshold quietly crossed from yellow to red. The margin call. Bank of America, Goldman Sachs, JP Morgan, the prime brokers who had lent the fund its firepower, now wanted protection. Post billions in new collateral, or we liquidate you. And a 25-year-old who had never traded through a bear market had about 72 hours to find money that did not exist. July 28th. The sell-off deepens, and the fund is bleeding at 4 times speed. July 29th. The banks are circling. Every hour of falling prices burns billions of collateral. July 30th. It's over. Situational Awareness agrees to sell its entire public stock portfolio, roughly $10 billion worth, to Ken Griffin's Citadel, at a discount, because in a fire sale, the buyer sets the price. That's why forced sellers always lose. Everyone in the market can smell that you have no choice. $35 billion. Gone in a single month. The fund that started July at $45 billion ended it holding roughly 10. The fastest fortune in hedge fund history unwound even faster than it was built. No fraud. No scandal. Just arithmetic arriving on schedule. Now here's the strange part. The fund isn't dead. What remains is mostly a $5 billion stake in Anthropic. Private shares that can't be marked down minute by minute and can't be margin called. Thanks to that stake and the early gains, some reports say the fund may still be up on the year. The public market bet died in 72 hours. The private one survived untouched. And the people who backed him, the Collisons, Nat Friedman, Jane Street, are still in, locked into what now becomes a private investment vehicle. Whether that's loyalty or just no exit, only they know. And the cruelest part? Aschenbrenner's thesis might still be right. AI may reshape the economy exactly as the essay predicted. But that's the oldest lesson in finance, and the market never stops teaching it. Being right isn't enough. The market only pays you if you can survive the ride. At 4x leverage, there is no ride. There's only a countdown. Wall Street has seen this movie before. Archegos 2021, leverage, concentration, margin call, fire sale. $36 billion gone in 2 days. The names change. The math never does. Because here is what should keep investors up at night. This blow-up happened in a tame market. No crash, no recession. One earnings miss and a nervous week. That's all it took to vaporize $35 billion. If 400% leverage is hiding anywhere else in the AI trade, and history says it never hides in just one place, then the next margin call is already loaded. The AI boom will mint fortunes, and it will vaporize them. Sometimes in the same portfolio, in the same month. If you want to know what's actually moving the markets, before it shows up in your portfolio, subscribe. And if you want to see the other bomb ticking under this economy, watch our video on the $586 billion debt wall coming due this year. It's on your screen now.